In what's been a good week for markets, this week we're going to talk about the online travel sector, specifically TripAdvisor and Expedia. We're also going to talk about Janet Yellen and her testimony this week, which is getting people more interested in rates going up a little bit faster than previously expected. So that feeds nicely into the best performer this week, which has been US financials, and our more recent recommendation of US Bank Corp. We like US financials, probably above UK, simply because we've got more visibility on the near-term operating environment. So for every 1% increase in Fed funds, we can see a 10% increase in EPS for Bank Corp. Equally, with the pullback of some of the regulation, we can see the loan-to-deposit ratio starting to increase, which will allow banks to expand their profitability without expanding their balance sheet, which is a key driver for earnings. Thirdly, we can see that corporate tax rate coming down, specifically in the US, and a reduction to 25% would increase earnings per share by 15%. And finally, we just see generally more activity in the US, which will have an increase effect on the ability for them to derive trading revenues or investment banking revenues. So it's realistic to be able to build a bridge to a 50 to 70% increase in earnings in the forecastable time horizon that we can see. That, coupled with valuations running at about 50% of the 2006 peak in terms of price to tangible book, suggests to us that there's a possibility of a geared return as earnings rise and the banking shares do re-rate at the same time. As you can see from this chart, which compares the S&P 500 banks index versus the FTSE All-Share banks, the market is starting to recognise that better near-term earnings trajectory for the US financials versus the UK financials. Looking at the week ahead, we've got a lot of UK financials reporting. So on Tuesday, we've got HSBC, we've also got Intercontinental, BHP Billiton, Medtronic and Home Depot. Wednesday, we've got Lloyds and UBM, TJX and Airbus. Thursday, we've got Barclays, Glencore, Baidu and Durr. And Friday, we've got BASF and Amadeus. That's it from me. Thanks very much.
Our two online travel stocks, Expedia and TripAdvisor, reported results that disappointed the market this week. And we wanted to highlight these companies as it shows why you can sometimes misunderstand a company by focusing purely on quarterly earnings. So both companies reported results that missed their expectations, but this was primarily driven by their investment to support future growth. So both companies have talked about higher marketing spending and advertising costs. And Expedia specifically has talked about doubling its spending on cloud computing. And that also gives you an indication of why we see the growth in cloud computing as a major theme for us at Killik. So results have disappointed because actually pretty robust demand growth has been masked by increased spending for the future. We think this investment makes sense as it gives these companies more of an opportunity to be able to grow share of the $1.3 trillion global travel market. We expect the overall travel market to grow anywhere between 3% and 4.5% over the next 3 years, with online travel growing 6% and online travel companies like Expedia and TripAdvisor growing over 10%. So in this context, what we see these companies as doing is trading results today for potentially higher growth in the future.
So it's been a pretty busy week from a macroeconomics perspective either side of the Atlantic. In the US, Federal Reserve Chair Janet Yellen provided her semi-annual monetary policy report to Congress. And in the UK, we've had a raft of important economic data releases. Starting in the States, Fed Chair Yellen's testimony to Congress, in which she provides US politicians with an update on the basic state of the US economy and its future prospects, is seen by financial markets as an important event, and particularly on this occasion because it's the first such report since Donald Trump was elected as president in November. The main questions going into Yellen's appearance were whether she would provide a guide on the future path of interest rates over the coming year, and also whether she would comment on any of Donald Trump's proposed policies. On interest rates, Yellen struck a positive tone on the state of the US economy. She spoke of an expansion in economic activity, a rising inflation, and a tight labour market, and she warned of the dangers of taking too long to raise interest rates. When asked specifically whether the Fed would raise interest rates in March, she refused to rule it out and said that if the US economy performs as the FOMC expects it to, then it will be appropriate for the Fed to tighten policy over the coming months. In response to Yellen's comments, the market implied probability of a US interest rate hike in March rose to 44% this week, which is the highest it's been. On Trump, the new president has called the Dodd-Frank bank regulation, which was brought in after the financial crisis, a disaster. He said that small and mid-sized businesses have been unable to access credit, and that it's hurt the profitability of US banks and also hurt their competitive advantage versus some of their peers. Again, in response to a question specifically on this subject, Yellen stated that, according to Fed surveys, very few small and mid-sized businesses have complained about being unable to access credit. And she's also said that US banks are profitable and that they've actually been gaining market share from some of their European counterparts. Indeed, this week, Goldman Sachs' share price reached an all-time record high. Moving to the UK, we've had a raft of economic data releases this week. Inflation, as measured by the Consumer Prices Index, rose 1.8% in the year to January 2017, its highest rate since June 2014. Meanwhile, inflation measures for UK manufacturers also increased. Input prices, that is, the prices paid by UK manufacturers for fuel and materials, rose 20.5% on the year, the fastest rate of annual growth since September 2008, and potentially indicates that consumer prices will continue to grow going forward. In contrast to the rise in inflation, data on the UK labour market showed that year-on-year wage growth slowed to 2.6% during the 3 months to December. The convergence between the rate of inflation and wage growth poses a problem for the Bank of England. A sustained rise in the rate of inflation might put pressure on the Bank of England to raise interest rates, but doing so would raise borrowing costs for the UK consumer at a time when earnings growth is slowing.